Today, I'll talk about investing with timeless discipline, applying David Dreman's crisis psychology to modern markets. Let me begin with a simple observation. The human mind is a remarkable instrument, capable of extraordinary reasoning, creativity, and foresight. Yet it carries within it a peculiar flaw. When confronted with uncertainty and collective fear, the mind has a tendency to abandon its careful calculations and surrender to something far more primal. We are, for all our sophistication, still wired to react to danger with the same urgency our ancestors felt when they heard rustling in the tall grass. The rustling may be nothing more than wind, but the instinct is to flee first and ask questions later. This ancient wiring serves us well when the danger is physical and immediate, but in the realm of investing, it becomes a liability. The rustling we hear during a market crash is not a predator. It is the sound of prices falling, often far below the intrinsic value of the assets they represent. And yet, the instinct to flee is overwhelming. We feel it in our chests, a tightening, a sense that something precious is being swept away. The temptation to sell, to stop the bleeding, to retreat to the safety of cash becomes almost irresistible. This is precisely where David Dreman's work becomes indispensable. Dreman, a legendary contrarian investor and author of Contrarian Investment Strategies, spent decades studying how psychological biases distort markets. He observed that the most predictable pattern in financial markets is not the movement of earnings or interest rates, but the movement of human emotion, from euphoria to despair and back again. His insight was simple yet profound. The crowd is often wrong at the extremes. When optimism is universal, prices tend to be too high. When pessimism is universal, prices tend to be too low. Dreman's crisis psychology, drawn from the field of behavioral finance, teaches us that market panics are not primarily economic events. They are psychological events. They are moments when the collective mind, overwhelmed by fear, abandons its capacity for rational assessment and begins to behave like a frightened herd. In those moments, prices no longer reflect sober analysis. They reflect raw emotion. And for the disciplined investor, that is the moment of opportunity. Consider what happens during a typical market crisis. A trigger appears, a banking failure, a geopolitical shock, a pandemic, a sudden tightening of credit. The news spreads rapidly. Commentators compete to frame the event in the most alarming terms. Predictions of catastrophe multiply. Within days, the selling begins. But here is the crucial detail. The selling is rarely driven by a reassessment of long-term fundamentals. It is driven by the fear that others will sell first. It is a cascade of self-protective behavior, each participant trying to escape before the exit narrows. By the time the panic reaches its peak, the selling has become indiscriminate. Solid companies with strong balance sheets and durable business models are swept up in the same tide as speculative ventures teetering on the edge. The price of a well-managed enterprise with decades of profitable operations may fall by 30, 40, or even 50% in a matter of weeks. And in that collapse, the crowd sees only danger. They see the headlines, the red arrows, the urgent warnings. They do not see what Dreman saw, the psychological exhaustion of the crowd, the moment when fear has run its course and value has been left exposed. This brings me to a foundational analogy that I have found useful in thinking about crisis investing. Imagine a busy marketplace on a summer afternoon. Stalls are filled with goods, merchants call out their prices, and customers move from vendor to vendor, comparing quality and cost. Now imagine that a sudden storm rolls in. The sky darkens, thunder cracks overhead. Rain begins to fall in sheets. What happens next is entirely predictable. The crowd panics. They abandon their shopping and rush for shelter. They do not stop to negotiate prices or examine the quality of what remains. They simply flee. Now imagine that you, unlike the crowd, have come prepared. You have an umbrella. You have a clear understanding of what the goods in this marketplace are truly worth. While others run for cover, you walk calmly through the rain, approaching the stalls where merchants are now desperate to make any sale before their wares are damaged. You find items of genuine quality offered at prices that, just an hour earlier, would have seemed impossible. The storm has not changed the value of the goods. It has changed only the psychology of the sellers and the buyers. The crowd's fear has created a temporary mismatch between price and worth. This is precisely the dynamic that Dreman identified and spent a lifetime exploiting. The market crash is the storm. The algorithmic volatility of modern trading is the thunder. The headlines are the lightning flashes that terrify the crowd. But the underlying businesses, the real companies with real products, real customers, and real earnings, remain standing. Their value does not evaporate with the panic. It merely becomes obscured by it. Now let me make this concrete with an illustrative story. Consider a fictional investor we will call Margaret. Margaret is a disciplined saver who has been investing steadily for 15 years. She has read Dreman's work and understands the psychological rhythms of markets. In the spring of 2020, as the pandemic spreads and markets around the world begin their rapid descent, Margaret receives the same alarming news as everyone else. Her portfolio loses 10% in a week, then 20%. The commentary she reads is uniformly grim. Experts warn that this time is different, that the economic disruption will be unprecedented, that the recovery will take years. Margaret feels the fear. Her stomach knots when she opens her account statements. She has the same wiring as everyone else. But she also has something else. She has a framework. She has read Dreman's analysis of past crises, 1973, 1987, 2000, 2008. In each case, the pattern was the same. Panic peaked, prices bottomed. And those who bought when fear was greatest were rewarded with returns that far exceeded the market's long-term average. So Margaret does the opposite of what her instincts demand. She does not sell. She does not retreat to cash. She does not retreat to cash. She does not retreat to cash. Instead, she has read-derm. She methodically adds to her positions in high-quality companies whose prices have been cut in half. She does this not because she has a crystal ball, but because she understands that the crowd's panic has created a statistical anomaly. The probability that these companies will recover and grow over the next 10 years is high. The probability that their current prices reflect their true long-term value is very low. She is not predicting the bottom. She is simply acting on the reliable tendency of fear to overshoot. Over the following months, markets recover. Within 2 years, the companies Margaret bought at the depths of the panic have more than doubled. Her discipline, born not from bravery, but from a clear-eyed understanding of crisis psychology, transforms a moment of collective terror into a foundation of long-term wealth. This story illustrates Dreman's core principle. The crowd is most wrong when it is most emotional. At the peak of euphoria, the crowd bids prices to unsustainable heights. At the depths of despair, the crowd sells quality assets at bargain prices. The disciplined investor's task is not to predict the crowd's mood, but to recognize when it has reached an extreme and to act in opposition. Now let me expand on this principle with a second story, one that highlights the particular challenge of modern markets. Consider a young investor we will call James. James began investing in the late 2010s, a period of remarkable calm and steady appreciation. He had never experienced a true market crisis. In his mind, the long bull market had become the natural order of things. When the volatility of the early 2020s arrived, James was unprepared. He watched his portfolio swing wildly from day to day. He found himself checking prices obsessively, his mood rising and falling with the market's daily movements. What James did not fully appreciate was that the volatility he was witnessing was not entirely driven by changes in underlying business values. It was driven, in large part, by the mechanics of modern trading. Algorithmic systems, programmed to react to price movements with lightning speed, were amplifying every tremor into a quake. High-frequency traders, operating on millisecond time horizons, were creating waves of buying and selling that had nothing to do with the long-term prospects of the companies being traded. James, like many investors, was being trained by this environment to mistake noise for signal. Every sharp drop felt like a warning. Every sharp rise felt like confirmation. He was being pulled into a reactive mindset, responding to the market's mood rather than acting from a considered plan. It was only when James encountered Dreman's work that he began to see the situation differently. He realized that the very volatility that was unsettling him was, for a disciplined investor, a source of opportunity. The algorithmic systems that amplified the swings did not care about value. They cared only about momentum. They would sell indiscriminately when prices fell, regardless of whether the businesses behind those prices remained sound. This meant that during periods of market stress, high-quality assets were often driven to prices far below their intrinsic worth, not because of any fundamental deterioration, but simply because the machines were programmed to follow the trend. James changed his approach. He stopped checking prices daily. He stopped consuming minute-by-minute commentary. He established a simple rule. During periods of extreme market stress, defined as a decline of 20% or more from recent highs, he would increase his regular investment contributions. He would direct those additional funds into a carefully selected basket of high-quality companies that had demonstrated durable profitability through previous economic cycles. The transformation in James's experience was remarkable. Where he had once felt anxious and reactive, he now felt purposeful. The market's volatility, which had previously been a source of stress, became a signal to act. He had not eliminated fear from his emotional repertoire, but he had given that fear a disciplined framework within which to operate. He was no longer at the mercy of the market's mood. He was using it. This brings me to the core principle I want to leave with you. The timeless lesson from Dreman's crisis psychology is this: fear is not your enemy. It is your informant. When you feel fear rising in your own chest, when you see panic spreading through the commentary you read, when the headlines are at their most alarming, you are receiving valuable information. You are learning that the crowd is in the grip of emotion. And history tells us that the crowd's emotion, at its extremes, is a reliable contrary indicator. This does not mean you should blindly buy every falling asset. Dreman was not a reckless speculator. He was a rigorous analyst who sought companies with strong fundamentals, reasonable valuations, and durable business models. The principle is not to buy whatever is falling. It is to buy what is valuable when the crowd's fear has made it cheap. Nor does this mean you should try to time the exact bottom. No one can consistently do that, and those who claim otherwise are selling something. The principle is to recognize when value has been created by panic, and to begin accumulating patiently, knowing that you may buy some shares before the lowest point and some shares after. The goal is not perfection. The goal is to be systematically present when prices are historically attractive. Now let me offer you actionable guidance for applying this principle to your own investing decisions. I will break this into several detailed points. First, you must prepare before the crisis arrives. Dreman's approach is not something you can improvise in the heat of the moment. When fear is at its peak, your cognitive capacity will be compromised. You will feel the pull of the herd. To resist that pull, you need a plan that you have already written down, a plan that specifies in advance what conditions will trigger your buying and what types of assets you will target. This plan becomes your anchor when your emotions are telling you to flee. Second, you must develop a clear definition of quality. Dreman focused on companies with strong balance sheets, consistent earnings, and sustainable competitive advantages. He looked for businesses that had survived previous downturns and emerged stronger. You should do the same. Create a list of companies or funds that meet your quality criteria during calm markets. When the panic arrives, you will not have to do your research in the middle of the storm. You will already know what you are looking for. Third, you must establish a systematic method for scaling into positions. Dreman did not advocate betting everything on a single moment of perceived bottom. He advocated a disciplined approach of accumulating over time as fear persists and prices remain attractive. You might decide, for example, that for every 10% decline in the market, you will deploy a predetermined portion of your dry powder. This method removes the pressure of trying to identify a single perfect entry point and replaces it with a mechanical process that takes advantage of sustained fear. Fourth, you must cultivate what I will call emotional detachment. This is perhaps the most difficult aspect of the discipline, but it is also the most important. Dreman understood that the greatest risk in crisis investing is not that prices will fall further. The greatest risk is that you will abandon your plan at the moment it is most needed. To guard against this, You must practice separating the market's price movements from your sense of self-worth. The market's decline is not a judgment on your intelligence. It is a mechanical consequence of fear. By depersonalizing the experience, you create space to act rationally. Fifth, you must ignore the noise. Modern markets are surrounded by a vast ecosystem of commentary designed to capture your attention by amplifying your anxiety. 24-hour news networks, social media feeds, and real-time price alerts are all engineered to keep you in a state of heightened reactivity. Dreman's approach demands the opposite. It demands the opposite. It demands stillness. It demands the capacity to look past the daily fluctuations and see the long-term trajectory of the businesses you own. I encourage you to consider a media fast during periods of extreme volatility. Your decisions will be better for it. Sixth, you must accept that you will be uncomfortable. Buying when fear is greatest means buying when everyone around you is telling you that you are wrong. Your friends may question your judgment. The commentary you see will call your approach reckless. You will feel at times like a fool. This discomfort is not a sign that you have made a mistake. It is a sign that you are acting in opposition to the crowd, and the crowd, at the extremes, is almost always wrong. Embrace the discomfort as confirmation that you are following the discipline. Now let me address a counter-argument that often arises in discussions of crisis investing. Some will say that this time is different. They will point to unique circumstances, a novel financial instrument, an unprecedented policy response, a structural shift in the economy that renders historical patterns obsolete. This argument has been made during every crisis in modern history. In 1973, investors insisted that the breakdown of the Bretton Woods system had permanently altered the nature of markets. In 1987, they insisted that computerized trading had introduced a new and unmanageable form of risk. In 2008, they insisted that the complexity of derivatives had made the financial system fundamentally unstable. In each case, the specifics were different, but the pattern was the same. Fear peaked, prices bottomed, and those who bought when value was most apparent were rewarded. This is not to say that every crisis resolves quickly or painlessly. Some recoveries take years. Some individual companies fail regardless of their apparent value. The discipline is not a guarantee of immediate success. It is a statistical approach that improves your odds over long periods. By buying quality assets when they are priced for pessimism, you tilt the probabilities in your favor. That is all any investment strategy can do. But over decades, that tilt compounds into meaningful advantage. I also want to acknowledge that this approach requires a long-time horizon. If you are investing money you will need in the next few years, crisis buying is not appropriate for you. The discipline I am describing is for capital that can be committed for 10, 20, or 30 years. It is for wealth that will be built slowly, through cycles, through storms, through the accumulation of quality assets acquired at favorable prices. This is not a trading strategy. It is a wealth-building philosophy. Let me return now to the central insight. David Dreman's great contribution was to show us that the market's crises, the moments when the crowd is most fearful, are not obstacles to be endured. They are opportunities to be seized. They are the periodic clearing of excess, the resetting of expectations, the moment when the speculative froth is swept away and real value is revealed. The disciplined investor does not flee from these moments. They prepare for them. They welcome them. They understand that the fear of the crowd is the foundation of their advantage. In modern markets, this advantage is amplified by the presence of algorithmic trading. The machines that dominate short-term trading have no understanding of value. They have no patience. They have no capacity for the kind of judgment that Dreman cultivated. They simply follow momentum, amplifying every move, creating deeper troughs and higher peaks than would exist in a market populated solely by human judgment. For the disciplined human investor, this machine-driven volatility is a gift. It creates moments of pricing dislocation that are more extreme and therefore more exploitable than anything Dreman experienced in his career. Your task is not to outrun the machines or to predict their behavior. Your task is to stand apart from them, to remain still while they churn, to hold your valuation framework steady while prices swing wildly, to be the patient buyer when the machines are programmed only to sell. This is the modern expression of Dreman's crisis psychology. It is not about outsmarting the market. It is about outlasting it. It is about having a temperament that can tolerate discomfort while the crowd, human and machine alike, exhausts itself. I will close with a final thought. There is an old saying in the investment world that the market is a device for transferring money from the impatient to the patient. Dreman showed us that this is not merely a clever aphorism. It is a description of a predictable psychological process. When the crowd panics, it transfers value to those who remain calm. When the crowd sells without regard to price, it creates the conditions for patient capital to acquire assets at a discount. The transfer is not mysterious, it is mechanical. It follows from the predictable failure of human emotion under stress. Your goal is not to be braver than others. It is to be more prepared, to have a framework that anticipates the crowd's behavior and positions you to act when the crowd is most emotional, to transform crisis from something to fear into something to use, to recognize, as Dreman did, that the greatest opportunities in investing are not hidden in complex financial instruments or secret strategies. They are hidden in plain sight in the moments when everyone else is looking the other way. The storm will come again. It always does. The rustling in the tall grass will return, and the crowd will run. When it does, you have a choice. You can run with them, surrendering your discipline to the instinct that served your ancestors but betrays your wealth. Or you can walk calmly through the rain, umbrella in hand, and acquire, at a moment of maximum fear, the foundation of your long-term prosperity. The crowd panics. The disciplined accumulate. And over time, that simple difference becomes everything. Your discipline is your greatest asset. Guard it well. In the end, we control our process, not the outcome. And part of a wise process is curating the ideas that shape your strategy. If this channel serves as a useful filter for you, I'd ask you to make one small, controllable decision to improve its odds of reaching others. Hit like to affirm the principle. Click subscribe to ensure your strategy gets the next insight. And if you found value, sharing it might be the highest odds investment you make in a friend's financial education today. Your support is what makes creating these videos worthwhile. I look forward to speaking with you again soon. Thank you.